During the past year, something very uncomfortable has happened to US-only investors. You see, international ETFs, they killed the S&P 500 in 2025, but that's not the only reason. Not only did they beat growth, but perhaps one of the most favorite types of investment strategies for me and a lot of people watching this channel, which you probably know one of them is momentum. Well, a lot of the international momentum ETFs, they took the favorite S&P 500 momentum ETF out to the woodshed. And yeah, I'm talking about SPMO, the S&P 500 momentum ETF, as you can see in this chart. And this immediately raises some questions. Is this just a fad, or is this something we've seen before? Because here's the part that most people miss, especially if you started investing recently. Momentum as a strategy, it's not new. It's been studied over decades, over different markets, over different time periods. It shows up again and again and again, not as a guarantee, but as a persistent pattern, which leads to a bigger question. If you're investing in momentum, or even if you're not investing in momentum, does it still make sense to stay 100% invested in US stocks? Well, today, hey, we're gonna be breaking that down. We'll talk about how sometimes international does beat the US. We're also going to talk about historical momentum returns. And newsflash, they're really good. We're also going to compare IDMO, or IDMO, which is the Invesco S&P International Developed Momentum ETF. We'll be comparing that to IMOM, or IMOM, the Alpha Architect International Quantitative Momentum ETF. And then we're going to throw in a US ETF, SPMO or SPMO, the Invesco S&P 500 Momentum ETF. And at the end of this video, I'm going to open up my portfolio and I'm going to show you which of these I actually invest in. So first, you might have seen this before on my channel, but we need to make sure you're up to date here. So markets work in cycles. Now, as you can see here, international stocks outperformed US stocks. From the year 1970 to 1990, 440% for international stocks, 225% for US stocks. International stocks had a way higher return than US stocks over a 20-year period. Now, let's move to 1990 to 2010. The US had a 230% return and international stocks had a 108% return. US stocks outperformed. However, inside of this, if you do look at the decade of basically the year 2000, 2010, international stocks outperformed US stocks. So there's cycles within cycles, but then to bring us mostly up to date, recently from 2010 to 2026, 16-year period, not quite 20-year period, the US has absolutely annihilated international stocks. 506% return versus 268% return for international stocks. And mind you, a 268% return is not bad. But herein lies the problem. We are in the stock market. Everything is relative. When you see your neighbor making tons of money because they invested in a semiconductor ETF, you think to yourself, I could have been investing in that. What am I doing? Am I missing out? This is just what we have to deal with when we're investing in the stock market. Now, if you have missed out on that, you might actually like this next part, which basically says, and this is according to AQR, which is a hedge fund with a bunch of really smart quants, they're saying over the next 5 to 10 years, US equities, US stocks are going to underperform international stocks. And generally, this is just because US stocks are more overvalued than international stocks. They're more expensive. In the US, we have high valuations compared to the international stocks, which have some lower valuations. And over time, these things might meet in the middle. That's kind of the idea. Hopefully we're caught up now on international versus US stocks. Sometimes international does outperform. I know for all of my American friends out there, I'm American. It can be hard for us to accept that we may not be the best stock market over the next 10 years. It's possible. I don't know what's gonna happen. However, what I do know is that momentum is persistent. If we look at the momentum returns over the past 5 decades, and this is long-only momentum, for those of you who do follow momentum, we're not building short portfolios in this. We're actually just saying if you bought momentum stocks and held them long, not shorting anything, we can see the returns here. These are different decades. So what we have here is momentum. That's the thing I want you to focus on. And basically what it's telling you is here, where it says 2.8%, that's saying during this decade, 1975 to 1985, how much better did momentum perform against the world market? Again, this is not US momentum. This is how did momentum stocks in the world perform against the world stocks. And so what you'll see, just for an example, let's say the world had a 10% rate of return. Well, this says 2.8%. That means that it was 2.8% better than the world. So if the world did 10%, momentum actually did 10% plus 2.8% or 12.8% annually over that decade. And these things add up to a lot of money. when you're talking about 2% over a decade, that's a lot of money. And if it continues happening, it's a lot of money. It compounds into a lot of money. 1985 to 1995, 3.1%. 1995, 2005, 4.7%. 05 to 2015, 1.9%. 2015, 2025, 2.3%. In fact, if you look at momentum, it's the only one that did not underperform the general world market over this time period. Momentum is persistent. Now, it's very common, whether you've been investing for a while or you're just kind of new to this whole thing, understanding what exactly momentum is and what we're talking about here when we are discussing momentum. Because there's different ways to define momentum, and you can talk about momentum in a single stock, or you can define momentum by like the entire general market and basically getting the stocks that have the highest momentum. We're talking about creating a portfolio of momentum stocks. We're not just saying, hey, buy a stock when it has momentum, which is a trading strategy that people use. So here, we can look at it like this. So when we're talking about IDMO, this is an ETF. And what happens is with ETFs, they're great because they're rules-based, unless it's an active ETF, in which case it's not rules-based. But this is a rules-based ETF. You know exactly what it's going to do and why it's going to do it. So what this does is it takes the S&P World ex-US Index, which is basically developed market. So you're going to have countries like Japan, Australia, even Israel's in there, Canada. So you're going to get all these different countries that are in the developed world. You're not going to get countries like China and the Philippines that are considered not developed yet. Those would be more emerging markets. So you're going to get developed markets in the ETF, and that's around 950 companies that are inside this index. So it's almost twice as big as the S&P 500 index, so we have more stocks to choose from than if you were just looking at the largest 500 companies in the US. You're then going to calculate what's called a 12-1 price return on all 950 stocks. What does that mean? I know it sounds crazy, but it's so simple. It's just like this. Throw into an Excel spreadsheet every single stock, 950 of them. Calculate the rate of return over the past year, but subtract the most recent month. The reason is because momentum has this tendency to kind of revert in the most recent month. So once you get past that month, you're potentially good. And once you calculate the return of all those stocks over that time period, all you do is you sort them in an Excel spreadsheet by the price change. Now, this particular ETF does one more thing. It takes the size of the company and it basically includes that in a score. So instead of just taking the highest momentum stocks, it's also saying which stocks are also kind of the biggest, give them a bit more weight in the portfolio. This makes it a bit closer to the index and to like what we're used to investing in, like the S&P 500 index, which has the highest weights in the largest companies. Same kind of concept here, but with momentum. Next up, they do an adjustment for volatility just to make sure that they're not getting like the crazy volatile stocks. And then what they do is they simply buy the 20% with the best score. That's it. What that ends up looking like is around 188 companies out of the starting 950 companies. That's the portfolio you're investing in here, and it happens every 6 months. And that's why what's great about this is it's rules-based. It just continues every 6 months, it's going to do this whole thing. It's going to go through a rules-based calculation. You know what it's going to do. If the market drops 50%, it's not going to change. It's not going to suddenly throw out the window its methodology. It's going to just continue, and that's a good thing. Now, with momentum, there are some interesting things that people don't realize. Number one, momentum is like a shapeshifter. You look at it one day, 1 month, 1 year, and then you look at it another day, or another month, another year, and it looks different. And it's because it's not investing in growth stocks, it's not investing in value stocks, it's not investing in semiconductors and sectors. It's literally investing in what is up. And what is up can change all the time. And so when this thing rebalances every 6 months, it will look totally different potentially 1 year versus the next year, or 6 months versus the next 6 months. And so right now, these are the countries that are invested in, the top allocations. But this could totally change by next year, let's say. So Canada might not be number one next year. And if you're interested to see, I just recently saw that the Israeli stock market is up like 50% in 2025. So momentum. Now on top of this, you're gonna have sectors that are also gonna change. Right now, this thing is very heavy in financials. Developed market financials are where the momentum's at right now. The next time it might be energy, the next time it might be materials, whatever it is, the momentum is in financials, and it's probably over twice the weighting of a normal general developed market broad ETF because that's where the momentum is right now. Now, before I open up my portfolio and give you a little peek of the ETFs that I have, so you will see which one of these I own, let's actually compare them against each other so we get a good idea relatively how they look. So 0.13% is the expense ratio for SPMO, a higher expense ratio, 0.25 for IDMO, 0.39% for IMOM. The yield, there's actually lots of yield in one of these. 3.53% yield in IDMO. That's actually a lot. So people who are interested in investing in yield, if you're a dividend investor by any chance who also likes momentum, this has high yield. I'm not saying it's going to always have high yield. It's going to go all over the place probably because it's a momentum ETF. Because if it's not investing in financials next year and if it's investing in tech, well, you're probably not going to have such high yields. But hey, right now you're getting a high yield. Next you have SPMO at 0.73%. That's what I'm talking about. S&P 500 momentum, like no yield. And even IMOM, which is like the pure, super pure momentum ETF here, it still has a 2.28% yield. Next up, we want to talk about two risk metrics. So first is the max drawdown. We're looking from December of 2015 here, and we're basically saying, since that time, what's the largest decline before it basically stopped declining and started going back up again? It could be any amount of time. It could be over like a 1 month period, a 5-year period, whatever. We're just saying like what's the most that it fell. And what we see here is a negative 30.96% time period for SPMO, negative 31.35% for IDMO, so very similar drawdowns. But then IMOM is the riskier one here, negative 45.74% for IMOM. Then we have volatility. Now, IDMO is actually a very low volatility ETF comparatively. It's actually kind of lower than the S&P 500 at 15.83%. IMOM having a 17.66% and SPMO having an 18.51%. And then moving on to like the amount of holdings, the diversification that these things have. IMOM is a more concentrated portfolio. It's a more pure momentum play. It's got 49 stocks in the ETF, so it's not a lot of companies comparatively. SPMO does have 101, IDMO has 188. Then when we talk about size or how many assets under management there are in this ETF, or these ETFs. SPMO is the largest with 13.4 billion. Then we have 2.8 billion for IDMO and then 0.1 billion for IMOM, which is very small comparatively. The part everyone loves to see, which are returns. The 3-year annual rate of return for these ETFs. I included SPY in here, so the S&P 500, just to see like as a benchmark, because a lot of us, me included, we gauge relatively how we perform versus SPY. That's just the way it is for a lot of us, and that's how it is for me. So IMOM had the lower return, 21.16%, SPY 23.83%, IDMO 25.43%, SPMO 29.69%. Next up for 5-year returns, we're going to take a look at IMOM having again the lowest return, which is only a 6.38% rate of return, and that hurts. Of course, when you're looking at just the general market, having a 16.28%, which is why if you want to do something like momentum, you got to understand its past performance, how it's done, what you're investing in, and you got to just like stay with it. If it has some bad patches, you got to stay with it. Or you got to understand if it's IMOM's problem. Is it the methodology they use that's the issue? So anyway, that's probably another video, but so we have 14.71% IDMO, SPY I already mentioned, SPMO 17.97%, the best return again. And then in a 10-year period, we have, of course, IMOM having the lowest return here, 8.57%, IDMO with 14.21%, SPY with 15.34%, and SPMO at 18.65%. Now, I should mention, I don't have a developed market ETF to compare this to on here, but IDMO did outperform the general developed market index. So I will say that that's important. Now, I'm going to tell you what I invest in, but you got to understand, a lot of things are not going to look as good as the S&P 500 because this cycle right now is very much in favor of the S&P 500, large companies, and the S&P 500 tends to tilt towards growth at this point. And growth and large companies, they've done much better than a lot of it, basically all the other parts of the market. That includes international markets, that includes emerging markets. US, large companies, their growth companies have killed it. We'll throw in momentum in there too. Momentum also has done really well with large companies in the US. So it's been hard to outperform the US right now, the S&P 500 index. So anyway, here's my public portfolio. If you want to get updates on my portfolio, I do send those via email. I also have 2 web apps that you can use. They're free, and all you have to do to get access to those things is sign up in the description below. I'll also email out my insights about what's going on, ETF investing, different things that I think will be helpful for you. So in terms of my portfolio, we will talk about momentum today. I have 2 parts of my portfolio that have momentum. I have US momentum, and I have international momentum. So in the US momentum ETFs, we have 4 different ETFs. I'm mentioning this so you know that I have SPMO. It's 10% of my overall portfolio here, but then let's talk about the international ETFs. So the international momentum ETF part of my portfolio is 10% of the portfolio. And so in here I have 2 different ETFs. I have IDMO and I have IMOM. 8% of my portfolio is in IDMO, 3% of my portfolio is in IMOM. I basically added these around the start of the year to this portfolio, and as you can see, IMOM is up 10%. So it's actually doing better. I'm telling you, this is the pure momentum ETF. That thing is way more pure than IDMO in that it's a smaller portfolio, it's only 50 stocks, it's equally weighted, so no matter how big a company is, it's gonna get the same weight. So it's really purely more on momentum score. IDMO is gonna look a bit more like the market, but it's still going to definitely have momentum. It's just not as pure as IMOM. And that's kind of what I think you need to understand when you're investing. You have to first figure out what you feel comfortable with, understand how certain strategies have worked in the past to help you have the conviction to use them going forward. Write down the rules that you should be investing in, write down why you're doing what you're doing. If you don't know, try to read as much as you can, watch as much as you can, figure it out. And if you're interested in investing in momentum, international investing, international momentum, I hope this video and some of my other videos have at least helped you better understand. And if you're still trying to figure this whole thing out and you wanna watch a video about some other US momentum ETFs, well, this one is for you.